Hey everybody, good to be here today. Time for managing an options portfolio. My name is Brent Moores. I do this each week at this time, and we're going to talk about using Greeks, your whole portfolio Greeks, to help you to manage your portfolio today. And then we'll look at some individual options positions that we have in our portfolio, talk about the management of them. But hey, I'm just glad you're here. We've got some new people here, as well as some people who have been around the block a few times. That's great. And I'm also joined in the chat by Ben Watson. Those of you who've been around Schwab probably already know Ben, but Ben, I've been working with Ben for over 20 years now, and I've learned a lot from Ben. Make sure you check out some of his webcasts. And if there's a workshop in your area, Ben is 99% chance there, I would say, because he does basically all our workshops. And so you're lucky to have him in the chat. Feel free to ask questions between Ben and myself. We'll do our best to help you out on that. Now, if you're on YouTube and you like content like this, like the other webcasts that we teach a variety of webcasts. Just make sure you subscribe to the channel and like the webcast. But to subscribe to the channel, it's the Trader Talk Schwab webcast, and that way you don't miss it in the future. All right. Hey, you can follow Ben or myself on X at Brent Moore CS, at Ben Watson CS. Let me just hit up a few disclosures, and then we'll get to the reason you're here, and that is to talk about managing options portfolios. Options do carry a high level of risk, though, and are not suitable for all investors. Multi-leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And rolling strategies can entail additional transaction costs, including multiple contract fees. So just because you put it on a rolling order on a ticket doesn't save you the cost by putting all the trades on that one order ticket there. The material today is for general informational and educational purposes only. The paper money software application, that is provided for educational purposes only. That's what we'll be using today, Thinkorswim desktop software. And let's see. Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risk, including loss of principal. Past performance is no guarantee of future results. Now, before I get too far into this, here's what I want to do. Let me bring up the Thinkorswim desktop software. I happen to have applied materials up, but you can bring up any stock. I'm on the option chain, trade tab, all products. We got it right here as an option chain. And I have my option Greeks here. This is just for the individual stock and the individual options contracts. We're not looking at the whole portfolio yet. We'll get there. But first, let me just point out, I have a delta column, a gamma column, a theta column, a vega column. I'm not going to focus as much on gamma today, but I am going to focus more on delta. Delta just tells you how much the option price of a stock, the option price is going to move in relationship to a $1 move in the stock price. Applied material goes up from $564 to $565, goes up a buck. We're going to see this option contract change from whatever it is, 37.75, up about 54 cents. Okay. So another way to think of this is if you're doing that option, the delta, okay, the delta is equal to I messed that up already, the option price divided by the stock as a percentage of the stock price, okay, per the stock price, okay. That's how that works. So how much the option price is going to move per dollar move in the stock price, okay. So let me go back right here. Theta tells us how much that option price is going to move per day of time decay on this. $2 move. So $2 would be taken out of our option price based on a one-day move here. Now, why is that? We're kind of at the peak we're at a high point of time decay on this. So that's a lot. That's about 5% of this option contract is going to decay for 1 day's worth of time. It doesn't depend on the stock price. I mean, it can, the theta will be different depending on what the strike price is in the relationship of the stock price and the stock price, strike price and the stock price. But the theta is how much it decays per 1 day move. That's the basic definition. Time decay can help us out or it can hurt us. We'll get into that in just a little bit more in just a minute. But that's what that is. We only have 9 days to go till expiration on these particular contracts that I'm looking at. If you go out longer, here's August, 44 days. Notice the theta levels are lower. Time decay increases as you get closer to expiration, typically. Typically, that's how that works. Vega tells us how much these option prices are going to change based on a 1-point move in implied volatility. We could bring up implied volatility right up here. Here's your implied volatility. It's very high. That's typically a pretty high number. Here's your implied volatility, but per point move in that is going to affect your option price by the amount of the Vega. Okay. So, but here's what I want to show you. I want to talk about these Greeks, but I want to talk about them in terms of the whole portfolio. But there's one other concept I want to talk about before we get to those and looking at those in the whole portfolio. And that is beta. Beta is a measure of how much the stock typically is going to move in relationship over an average. So it's not an exact prediction of the future, but how much the stock is going to move in relationship to the S&P 500. If you're on the trade tab, you may have to open it up under underline with this little arrow right here. If you go here, it'll say beta or fast beta. Fast beta just looks back a year. Beta looks back 5 years if there's 5 years of data there. And basically what this says is how much this moves per dollar move in the underlying stock in the S&P 500. S&P 500 goes up 1%. This is going to go up. This has gone up about 1.36%. If the S&P 500 has gone down about 1%, this has gone down about 1.36%. So it's a measure of volatility in that regard. But what we can do, now that we've talked about delta and beta, we can look at that in terms of the overall portfolio. Now, to look at your Greeks on your portfolio, what you're probably going to want to do is ungroup them, because I have a lot of different groups here. I have my long verticals group, my long single options groups, etc. If you go to the three-line menu and don't show the groups, you'll see at the bottom of the page, delta, theta, vega, right down here, and you've got the totals. Okay, we've got the totals for the whole thing. I don't need this much space over there. Let's give ourselves a little bit more space so we can actually see the vega here on that. Okay. And of course, you can sort by any of these columns that you want here. But there's our column totals. So what does this mean? Well, as we look at the individual line items, we can see for this BSX position, which is a diagonal spread, I can see my delta is about minus 134. So in other words, if BSX moves $1, we're going to see about a $134 move in our profit or loss on that. Just an estimate on that. But that's great for BSX, but Caterpillar is a very different price stock. CNP is going to move very differently. Each of these are very different. So what we can do is we can standardize these, and we could say, how much are each of these going to move in relationship to a 1-point move in say the S&P 500? So I'm going to go to the SPX here. I'm going to go to beta weighting right here. I'm going to check on beta weighting, put a check mark by that, and I'm going to type in SPX. Okay, I'm going to click on SPX. And now when we look at our delta, what it's telling us, we're looking at the portfolio delta total right down here. What it's telling us is for every point move in the SPX, we'd expect, it's an approximation, about an 18-point move, dollar move, in terms of our profit or loss of our overall portfolio. So let's consider the SPX here for a sec. What's the price of the SPX right now? SPX right now is about 74, I'm just going to jot this down, 45, 74.45. A 1-point move in the SPX isn't much. It's down about 57 points today. And today is just kind of a typical day, down about 57 points. 57 points today. How much would we expect our portfolio to move on a day like today? Well, if for every point move, it moves $18, if I take $18 and multiply that by the 57-point move, I come up with about roughly $1,000, okay? So roughly $1,000. Can your portfolio withstand that? Every portfolio is different, okay? Every portfolio is different, and what your portfolio is showing is going to be very different than mine. And so, as Sam mentioned in the chat, it depends on what your liquidity is, what your net liquidity is, and you can look over that over here, and you can go to your account info, and you can go. Let me just show over here, and you can. Let's see. Let me just see if I can. Why is that not giving me the privacy? There we go. So you can see your portfolio values there. And so this is just a dummy account I have right here, and it gives me a lot of buying power. So it's not a problem here for this portfolio. But you have to ask yourself, given a potential move in the SPX, how much risk are you willing to take? What if the SPX goes down 5%? Well, how much is 5% on the SPX? Well, we said the SPX was 74.45 times 0.05. That gives me about a 370-point move, roughly, on the SPX. So if I take that 300, this would be a 5% move on the SPX as an example. And that's not, that would be a huge one-day move. But over the course of a couple weeks, that maybe isn't that much. For a 5% move on the SPX is about a 370-point move. 370 points times my delta, my beta-weighted delta, which is, it was 18. So if I take 18 times $370, I come up with about a $6,600 move on my portfolio. Now, obviously, I don't want that to happen, but you need to keep these numbers in line as to what risk you are comfortable with. Can your portfolio withstand that move? If it's too much, you need to reduce your delta in your portfolio. So then you can do trades to do so. You can take existing trades off. Look, I've got a Caterpillar trade where my beta weighted delta is about 4.5. That's a lot. That's about a quarter of the portfolio. If I just remove this trade, I would reduce my delta. Now, I don't want to at this circumstance, but the first line you can consider, if your delta is too high, is removing existing trades. You can also add on other trades to lower the delta. You can put on negative delta trades, bearish trades, in other words, to help manage your delta, to manage your portfolio risk there. So you need to just take that into account there and decide what you want. Now, maybe you want a more bullish delta. Obviously, you can add on bullish trades if you wanted to. Here's NVIDIA. This is another one. These two trades here are probably a third of my overall portfolio delta. Okay. So typical portfolios, and this isn't a recommendation, but typical portfolios are going to be bullish portfolios with positive delta. You can modify that though by the trades that you take on how you manage these options positions. So when you're looking to modify it, you can consider delta. Obviously, that's a big one. Maybe you consider theta. Obviously, we'd like to have time decay working in our favor, but with some trades, it's not possible. If you do a long call like I have on Caterpillar, it's going to have a negative theta. That's going to detract from that. But maybe I want to bump up my theta. I can look to add positive theta trades to this. Right now, my theta is I'm losing about $100 a day on this portfolio just because of time decay. Now, when I say I'm losing $100 a day because of time decay, that's everything else being equal. Obviously, the portfolio may go up or down or whatnot based on what the price is doing, but just on time decay alone, that's what the impact is, the impact of time decay. So, and it's not actually a realized loss until you actually sell. That's true for all of these. Vega, I have a positive Vega. And when you're considering your Vega, what you may do is you may look at the VIX and say, well, here's my VIX, and it's kind of jumped up today, right? We've had some news regarding US and Iran, oil prices jumped, implied volatility has gone up a little bit. But all in all, over the last 6 months, as of yesterday at least, we were kind of at a pretty low level. We've jumped up a little bit here, but depending on where you think Vega is likely to go, and remember, where the VIX is likely to go, that may tell you whether you want to have a higher Vega or a lower Vega. If you think the VIX is low and is likely to go higher, a higher Vega may behoove you, or vice versa. It's not a right or wrong answer for any of these Greeks here. But when you're looking to add in trades to modify these, what you could do is consider what you got. Consider what the type of trade you're going to do, how it's going to affect your overall portfolio. A long call is a bullish trade. And so what it's going to do is it's going to add positive delta to this trade. Okay? It's going to add positive delta. So let me just write, I'm just going to say positive. Theta, it's going to add negative theta. Vega, it's going to add positive Vega. So with a long call, it's bullish. Time decay works against you. And implied volatility, an increase in implied volatility is going to help out the trade. With a long put, our delta is negative. It's bearish. The theta and Vega profile are going to be the same. Time decay is going to work against you. Implied volatility will work for you if it goes up. Short calls are going to be opposite long calls. Delta is going to be negative. It's a bearish trade. We don't typically do short calls or just naked calls. So what you may consider is like this in the context of a covered call. Okay? In the context of a covered call, we've got data. But one reason why people do covered calls is it adds positive theta to the portfolio. Now, one thing you'll notice on these is when we're talking about our single options, our theta and Vega are going to be opposite each other. Negative, positive, negative, positive, positive, negative, and this is going to be positive. It's supposed to be POS, positive, positive, negative. And a short put is a bullish trade. So delta is going to be positive. So if we're adding these on here, onto your portfolio, new trade, That's how it's going to affect each of those Greeks. But the thing is this, with these single options, the ones we've talked about so far, single legs, they're probably going to be pretty substantial impacts. Okay? They're probably going to be pretty substantial impacts. And because they're single options. When we start to get to vertical spreads or these other spreads down here, as we start to look down here, you're going to have a positive, a long leg, and you're going to have a short leg. And they're going to offset each other to some extent. Maybe, probably not entirely, but to some extent. So when we look at a short put vertical, and we say, oh, that short put vertical is a positive delta, it's bullish, that delta is not going to be the same as the long call delta. It's going to be less probably. Okay. Long call vertical, kind of the same deal. It's a positive delta. It's a bullish trade, but these aren't going to impact your overall portfolio Greeks probably as much as these single options that we'd be looking at here. Okay. But a short put vertical, what's our theta on that? Well, positive time decay helps you out. Because if you're doing these, I notice I have OTM there, out of the money, short put vertical, short call vertical. Typically when we're doing these short verticals, we're doing them out of the money. But when we're doing these, the short leg is kind of the driver leg. It's the one that has more impact. Therefore, the Greek profile of that is going to match the Greek profile of the short put, for the short put vertical. Positive, positive, negative. For the short call vertical, it's going to match the Greek profile of just the short call. Negative, positive, and negative. All right. Good. Now, long call verticals. Notice I put ATM next to my long call verticals and long put verticals. The reality is the Greeks on these are going to depend to a large extent, especially our theta and our vega, on what strike prices you pick. Your theta could be negative or positive depending what strike prices you pick. What I'm showing you here with out of the money short verticals is how these trades are typically, not always, but typically implemented. Typically short verticals, we're doing them out of the money. Long verticals, long call verticals, long put verticals, we're usually doing them kind of at the money. So just realize when I'm doing these can be, depending on what strike prices you do, and that's why I specify at the money here on this. It depends. If we're doing them at the money, the Greeks are probably going to largely offset each other. So I'm going to say neutral on that and neutral on this. Now, when I say neutral, is it going to be zero exactly? No, it's not going to be zero exactly. By neutral, what I mean is it could be a little positive, it could be a little negative. It really depends on what strike prices you want. So I'm not sure on those exactly how to designate that. But a long put vertical is a bearish trade. So if I want to add some positive delta and not affect my other Greeks that much, a long call vertical may be what's in store. Calendars, diagonals. Well, calendars are typically considered to be more neutral trades. Obviously, if you're doing a diagonal spread, it's going to be bullish or bearish depending on what kind of diagonal you're doing. But something they do have in common is time decay is positive. It's beneficial to you. You can add positive time decay of your portfolio if you do that. Your vega is positive on those. Notice the whole theta and vega thing they're not always opposite each other on all the trades, but those single options, yes, they're They're going to be opposite each other. Iron condors, that's typically a neutral trade. Depending on what strikes you pick, you can make it a little more bullish or a little bit more bearish. Time decay helps you out on that. And implied volatility, it's beneficial if implied volatility drops. Butterflies, pretty similar. Kind of neutral, depends on what strike prices you pick. Theta, positive. Now notice all these trades right here. Calendars, diagonals, iron condors, butterflies. Time decay helps you out. One way to determine which one you're going to do is what your vega is. Positive vega for calendars, iron condors and butterflies, negative vega. Notice these two are like, excuse me, these two seem to be identical, right? I would kind of summarize them this way. Butterflies typically are lower probability, but higher potential return. That's a generalization, but typically lower probability, higher return on risk on those. Very often, if you've seen my webcast before, either this one or the advanced options webcast I do on Friday, you'll notice that when I do butterflies, very often I'll skew them. I'll make them unbalanced because I try to make them higher probability because I don't love the low probability aspect of those. But that's one of the differences there. Let me go and I wanted to bring up one more. This is not an exhaustive list, okay? But I need to cut it somewhere. But when you're thinking of other trades, and my example here is going to be callers. A caller is you buy a stock, okay? You sell a call, and you buy a put, or you do a long put, okay? So there's your caller. When you're thinking of other trades, you just need to put them together here as what the component parts are. So for example, on a caller, what's our delta on a stock? 100 shares of stock. It's going to have 100 delta, okay? What's our delta on our short call and our long put? Well, it depends what strikes you do, but very often we'll do them maybe out of the money a little bit, okay? Typically, maybe a 30 delta. So we would have a negative 30 delta. And if do long put, out of the money, negative 30 delta. These are just approximations. My sum delta there would still be positive delta 40 in that case. So if you have a more complex trade like that, you just need to kind of look at the component parts of it and piece it together. So I'm going to put callers as positive delta. Now, if you did both your short call and your long put at the money exactly, well, it'd probably be pretty close to a neutral delta on that, okay? Because they'd both have a delta of approximately 50. They would sum together to be 100, which is what the stock delta is. So our delta would be neutral in that case. But typically, and that's what I'm going with all these, is typical, that's going to have a positive delta. Your theta is probably going to short call, positive theta, long put, negative theta. Your theta is probably going to be relatively neutral. Your vega, same deal. They offset, relatively neutral. This can be kind of a guideline, if you will, a typical guideline in terms of adjusting your portfolio Greeks, your total portfolio Greeks, with additional trades here. Now I'm just going to set that on my screen there for a second. Let it sit there. And what I want to do is I want to just check chats, and I appreciate Ben for his comments in the chats. Ben says it's important to remember that sensitivity to Greek changes based on days to expiration. Yes. So these Greeks, this is a very important point that Ben brings up in the chat. And if you're watching on a recording, you didn't see that. So I want to just emphasize that. Your Greeks can change based on what the stock is in relationship to the strike price. Okay, that's one thing that's going to change them. Days till expiration is another biggie. Okay. For your delta, yes, the stock price is a prime consideration there. But for your delta, as you get closer to expiration, your Greeks are going to either drift towards 1 or towards 0. Okay, so if they're in the money, they tend to drift towards 1. If they're out of the money, they tend to drift towards 0. Theta typically goes up, increases as you get closer to expiration. But theta also is different depending on where you are in relationship to being at the money. Okay, those that are at the money are going to tend to have a higher theta. That's true for a Vega as well. Okay, so just keep in mind those. So Ben, I appreciate there. Okay, so let me go and clear this out. Now, do I have a guideline for what the Greeks you want? Well, look, ideally, I'd want my theta be as positive as possible, as high as possible. Okay, ideally, I would have that. But you're sacrificing that. You're sacrificing something if you do that. Because if you want a bullish portfolio that's quite bullish and you start adding a bunch of long calls, practically you're not going to have a positive theta portfolio. So it really depends on how bullish you want your portfolio, how much risk you're willing to take on that. The way I would ask you to consider this, though, is consider drawdowns in the S&P 500, okay, because we're beta weighting the S&P 500 on your delta. 10% drawdowns are very typical in a year, okay? They're very typical in a year. 5% drawdowns typically will occur multiple times during a year, okay? Your portfolio needs to be prepared for that. So if you consider kind of a 10% drawdown over the short term as a possible scenario, definitely a possibility with that could be likely, make sure that the risk you have, your beta weighted delta on your portfolio, can withstand that. We don't want that. We don't want it to happen, but you need to be prepared for that. Vega, it's probably going to be, do you expect implied volatilities to go up from where they're at or down from where they're at? Okay. But just like with theta, if you have a bunch of long calls and long puts in your portfolio, you're probably going to have a Vega positive portfolio. But you may want to take that down. If you think implied volatilities are going to drop, you may try and reduce your Vega there. All right. So that's that. Now let's look at this portfolio. I'm going to move this off here. Okay. So here's my portfolio. I have a positive delta. I have a negative theta, largely driven by those two positions I already mentioned. And I have a positive Vega. Well, Vega, it spiked up a little bit today, but in general, my impression is Vega, the VIX spiked up a little bit today, but my impression is, in general, there's more upside on the VIX than downside on the VIX. Would be that. But remember, if you're doing spread trades, it's probably not going to affect it that much. Now, let's say, for example, we do a trade that is going to reduce our delta some, increase our theta some, reduce our delta, increase our theta, and reduce our Vega a little bit. Okay, so increase our, reduce our delta. Well, a short call vertical reduces our delta. A short call does, but I'm not going to do just a naked call here, okay? Short call vertical does. It would increase our theta, and it would decrease our vega. So that fits the bill on that. And um, and these, we could skew these a little bit more to do so. And um, so let's look at a short call vertical. Okay. So right now, that's probably not going to, it's not going to affect it a ton. Our current delta is 1817. It's changing as I talk here, but so we'll say around 1820. Let me just jot that down as it moves on us. Let's look at, say, a short call vertical. Okay, so I'm going to go here and I'm just going to look at something like BMY. And here's my take on BMY. This is technical analysis. We're going to say this is the trend that we've had. This is the downward trend that we've had. I'm going to assume that we have some resistance around this area. Okay? I'm going to say we have some resistance around that area. So I'm going to make this more of a bearish trade in this regard. Technical analysis isn't the only way to do it, but what I'm going to do is I'm just going to do a short-term trade here. I'm only going to go out 9 days on this. I'm going to do a short call vertical on BMY. So I'm going to go here. I'm going to sell my 59 strike. I'm going to buy my 60 strike. I'm going to click down my control key. I'm going to up my contracts a little bit because right now, if I look at this, I'm risking 76 bucks. Well, I can make it bigger than that here. So I'm going to add some more contracts to this. Now let me analyze this trade. I'm going to click on the Analyze tab, and we're going to look at risk profile. We're going to look at BMY, and from just an individual stock perspective, not a beta weighted perspective, this would be adding negative delta, positive theta, negative vega, just like we said. But let's do this. I'm going to send this trade, and I'm going to confirm and send, and I'm going to add this. Oh, I don't have groups here. I'm going to send this trade. So we just sent that. And then what we can do is we can look at our portfolio. We get rid of this. And we can look and our beta weighted delta didn't affect it much, okay? Because we did that vertical spread here. We did BMY, and you can just look at the magnitude of these. From the grand portfolio perspective, our delta didn't change much, 0.04. Our theta, about $4 a day to our benefit on that, and it reduced our vega a little bit more. Now, let's say we want to make a more impactful decision. What we can do is we can then just do a bearish trade here. And so what you can do is you can find a stock that you believe is going to be more bearish. And I'm just going to pull up a watch list. And I'm just going to scroll down and find something that looks a little bit more on the bearish end of things. And I'm going to say we're rolling over here on Citigroup. Well, we got earnings. I'm going to probably skip Citigroup earnings here on this. Oh, what do we have? I got Meta. I'm going to do the same approach on this. And I'm going to say on Meta, we're kind of looking at more of a bearish trade. So I'm going to do a shorter term long put on this. So I'm just going to do a long put. I'm not going to go out 9 days. I'll go out 44 days. And I'm just going to do this at the money. And I'm going to buy a put. And the stock's at 6027. So we're going to say 605. I'm going to just throw on this trade. And I'm going to confirm and send. And I'm going to send that trade. So we just did a long put. So what's the long put going to impact? How's that going to impact my portfolio with Meta? Well, let's look. Let me get rid of this left-hand column. Oh, now that's a substantial impact. We went from 18 down to 10 on my portfolio. So I definitely reduced my overall delta on my portfolio with my long call on there. Now, here's the problem. By doing that, by significantly impacting that, we did a long put, we also added some negative theta in there as well, which, well, that's the consequence of those long puts there on that, okay? So when you're considering your whole portfolio, consider what you want to do with the numbers. Is your portfolio too bullish? Add some bearish trades or take off some bullish trades. Do you want to add some theta? You can look at trades that add positive theta. If you want to adjust the vega, the same thing. But just remember, your long options here are going to be much more impactful than your spreads, because the spreads, you got two contracts that are kind of largely offsetting each other as you do that. There's not a perfect portfolio. You know, you may say, I want, you know, my delta to be big and positive or big and negative, whatever. And I want my theta to be positive at the same point. It's trade-offs though. Sometimes you got to make trade-offs on that portfolio as you do that. Now, that's how you can affect it. Now, I'm running out of time, but I wanted to get to just looking at some of these trades here real quickly and doing this. Let's look at our short verticals here. We've got some that are going well. Some of these trades are going well and some not so well. Amazon's not doing so well. Remember, with these short options, here's 3 short vertical spreads. Okay, Coke, Amazon, and Norwegian. I've got 16 days to go on all of these. Typically on these trades, when I get less than about a week, we'll say about a week to go to expiration, we're going to look to exit those. We don't want those to get all the way to expiration, okay? Or within even a few days of expiration. So usually with about a week, we'll look to get out. Well, we got 16 days. So there's no necessity to get out. If we've made 80% of what we can make on those, or somewhere in that range, we're probably going to automatically get out. We're pretty close on our Coke trade, okay? So that's one we may get out. If we have a technical breakdown on these, we're going to look to get out of the trade. So let's look quickly at Amazon. Let me get out of my drawing tool. On Amazon, I have a 245, 250. Let me pull up my charts. AMZN. Amazon, 245, 250. We're at about 241 right now. Now remember, this is a call. This is a call vertical. This is bearish. We want the stock to stay below 245 here. Am I still bearish on it would be the decision here. I'd say I'm willing to stick with this and call this a resistance level. If we break above here, we'll probably look to get out. Otherwise, what I'm going to do is this. I'm going to look at this and say, my time decay is still helping me out on that trade. I'm willing to give that a little bit more time. Okay. Coke, again, we still have time before expiration. There's not that much left we can make on this trade though, right? The current price of the spread is about 5 cents. I'm just subtracting the 13 cents from the 18 cents. About 0.05 is all we have left. The best scenario on this is it goes worthless. Well, it's almost worthless. There's only 5 cents to go on this. So I'm going to take, it's not a big profit, but I'm going to take what we have on that and get out of that at this point here, because there's just not much more we can do on that trade. I'm going to highlight it. I'm going to create a closing order. I'm going to buy that back. And we're going to confirm and send, and we're going to send that order to get out of that trade. Okay, so we're going to take that profit on that one. Norwegian Cruise Lines here. This is obviously not going well. We're down $100 on the trade, and we're actually in a little bit of negative theta. Time decay is actually hurting us on this. It's a short put vertical. We want it to stay above $20. NCLH is our ticker, NCLH. This is not looking very bullish right now. So what I'm going to do is, I don't like to take the $100 on this, but even if it goes sideways, time decay is working against us at this point. We're just going to cut our losses on that one and get out of NCLH. Okay, now here's the thing. I'm out of time. And so what I'm going to do is, I'm going to finish this trade off. We're going to get rid of that. I'm going to just mention this. Make sure you subscribe to the Trader Talks channel so you don't miss future episodes. I'll be back next week at this time, and I will get through. This week I kind of ran out of time in terms of managing some of these positions, but we have long single options that we got to manage here. We've got long verticals we got to manage. We're going to hit up more of those next week and talk about more of these individual trades next week. But today I wanted to talk about managing your whole portfolio, using beta weighting to see your portfolio weighted delta, using the total portfolio Greek summary. Remember, you can I clicked on the wrong thing. You can ungroup your portfolio and look at your totals for your portfolio. And you can make your trades based on that as a consideration. Obviously, it's not the only consideration. You got to make sure that individual trade, if you're using technical analysis, looks good and it matches with what you want as well on the individual trade. But your overall portfolio Greeks can be an important consideration. Thank you, Ben, for helping me out in a chat. And to answer Chris, no, the portfolio beta delta doesn't need to be close to zero. Only if you're totally neutral. Okay? If you're more bullish, you want a higher delta. If you're more neutral, you want a lower delta. If you're bearish, you'd actually maybe want a negative delta. Okay? Everybody have a great rest of the day, and we'll talk to you later. Bye-bye.